This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Now, what I would put much in is some of these stories you saw over the weekend, and Powell referenced it again today in a virtual conference he was doing about Fed coin, or some type of digital currency, if you will, that the Fed is ultimately going to create. And what does that mean? I will just again refer you back to Powell's speech at the virtual Jackson Hole Down. And what he said there, and what he said often since, is that he is fearful of the U.S. getting into a deflationary cycle like Japan, where deflationary expectations lead to deflation, which means to even greater deflationary expectations, which mean to even more deflation. And pretty soon you got the Bank of Japan owning 60% of all the Japanese ETFs, and all of the bond market and everything else. They're so desperate to flush cash out. And what Powell said he wants is unconventional, or maybe it was non-conventional monetary tools that they're looking at. That's what this digital coin is. It's a non-conventional monetary tool. Oh, there'll be some other uses of it, I'm sure. But what they'll really be able to do is just simply, it's not helicopter money, it's zeros and one money. How about that? Does that make any sense? It's you've got a bank account and we're just going to give you some cash directly into your bank account. Okay? You don't have to show up. We don't have to send you a check. You don't got to take the check down to the bank. We're just going to credit your bank account like an ACH transfer. Okay? Oh, hey, here's $1,000. Now go spend it. That's helicopter money. That's what Powell says he wants to do, and that's part of what this coin, if you want to call it that, will be. It's coming. I don't any doubt about it. I mean, all these central banks are talking this way. All of them interested in maintaining their power, maintaining the system. They know how much cash it's going to take to do that. You've got to grow the monetary base, all that stuff fast enough so you can continue to service the debt. If not, you're screwed. And that's all part of what these steps are. So anyway, all these things, I mean, maybe that's all part of why the banks are saying they've got $40 price target in silver and a $2,500 price target in gold, because they know it's coming too. I mean, it's not like it's, you got to be Nostradamus to figure this stuff out. Somebody doesn't want to see silver above 25, right? Okay, I wonder who that somebody could be. And why would 25 be important? Well, there's your next to last chart. Again, 25. Now, we know how important 26 is, okay? Because that was the support and floor for 19 months back in 11 through 13. And 26 is important. And 26 held a support for a little over a month in August and September. But look at 25. Right there at the end of August, we went flying up there. Had that crazy day where we got all the way up to 26.50 and then all the way back down to 22.50. But there's a period of 6 days there where we could not get above 25. Just kept getting beaten back. And then finally in early August, we got above 25 and blasted through 26. In fact, went from 25 to nearly 30 or higher in 4 days. So if you're a bank monkey, do you think maybe you want to keep price below 25? Okay, so now look at the current action, not just today, but yesterday. I guess go back to October the 9th, where we closed above 25, only to be immediately reversed as soon as the banks came back to work after Columbus Day on Tuesday the 13th. And now again, here's a pennant. Look at that. How many more days can you fit in there? 3. So we've got similar chart patterns that look to close by the end of this week in both the dollar index, gold, and silver. What do you know about that? All right, now this is fun. Check this out. I want you to look at these two charts side by side. The first one is February gold showing this period last year. The second one is the current chart. Now, they're not necessarily identical, but they're pretty damn close. Remember, how many times have I told you this year's a lot like last year? Last year, we met our price goals and rallied into the early part of September. This year, we met our price goals and rallied into the early part of August. Then we began a pullback, just as we began a pullback last year. That pullback last year lasted really almost 90 days, or maybe a little more than that, from early September into the middle part of December. This year, the pullback is almost 90 days. Now look, last year, there was a clearly defined pennant, and notice the action around the 50-day. Hanging above it in September, blasted down with a huge, $30 red candle at the end of September, kept trying to get above it, and failing, getting slammed backward all through October. And then in early November, bam, slammed again. $30 candlestick, a day off, $30 candlestick, all the way to the lows that were ultimately $120 or about 8% down from the high. Then we started rebuilding a lower part of a pennant. And then suddenly, at the middle of December, we broke out of the pennant, got above the 50-day, and then it was off to the races. Look at this year. Slammo. Finally, most of the time, holding it above the 50-day until that slam of a month ago with the dollar index. Slam. Look at that, $30 candle. Kind of a day off, another $30 candle. Does this sound familiar? Now we've been building a pennant, building a slow, gradual uptrend, and now finally breaking out of the pennant, just as we did last year on December, whatever that is, 15th, 18th, and now trying to get above the 50-day as well. Now do you understand why the banks are fighting so hard to keep us below the 50-day? Okay? Do you understand where I'm coming from? However, do you see how much this looks like last year? And now the key will be, see the one little thing on this chart, see that little line there? It says 1939. That's the intraday high from last week. Remember we had the big rally on Friday the 9th, holiday on the 11th or the 12th, and then smashed backward. Well, the intraday high that week, last week, was 1939. If we can continue this week, continue to rally, we'll get a stimulus deal, whatever. We finish the week not only above the 50-day at 1933, but above that previous week, intra-week high of 1939, we'll be on our way, just like we were last year. Now, the last time we had a bottom, and this is when you got to start paying attention to this podcast. The last time we had a bottom that was tradable was in early June. Okay, remember what happened? We had, when I was on vacation in North Carolina, suddenly the yield on the 10-year note shot from like 69 basis points to 96 basis points in a week. I didn't even look at prices. I came back Friday the 5th of June or whatever. I was like, oh my God, this is terrible. We've had a terrible week. And the BLSBS was that day. And we looked like we were breaking down out of the range that we'd been in for 90 days between 1680 and 1780. We got like to 1672. And I even wrote that day, said, well, we better get back above 1680 by the close. And we did. But that was the day the bond market turned. Fed wasn't going to allow the 10-year note to get over 1%. In fact, they wanted to get it back down below 75. And eventually, by early August, 2 months later, we'd gone from 96 basis points down to 51. And it was over that period of time that we went from 1680 to 2080. Okay? So I tell you all this now because the 10-year note was up 5 basis points in yield today down to 86. 86. Okay, within 10 basis points of that high in early June. I am a firm believer the Fed will not allow it to go over 1%. That they'll start buying bond futures, they'll do whatever. And they're going to drive it back down. These people out there saying, well, with a stimulus deal, where's that money going to come from? As if, what is this, 1992? Man, in 2020, I'll tell you where the money's going to come from. The Fed's going to create it from nothing. They're begging for U.S. debt to monetize so they can get as much cash out there as they can. Then you're going to start getting into helicopter money and all this other stuff that's coming next year. And all of it is designed to inflate away the current existing debt. The next step in all those trial balloons this fall that we saw last summer was to have yield curve control. Like I said, I think they've already instituted it. We're about to get a test to see if I'm right again. And that's when we're going to get a turn here. Okay, the dollar's already pulled all the way back into that range, right? Up a little bit today, but still only 93. Down from 103 when QE to infinity began. So what's going to happen next is the bond market is going to rally and yields are going to come back down, either by Fed enforcement or whatever, stock market going down and safe haven demand. Who knows what it'll be. But as the yield comes down again from 70 down to 60 and negative real rates get even more sharply lower, we're going to rally again. We went from 1680 in early June with the yield approaching 1% on the 10-year note to 2080 in early August with the yield approaching 50 basis points on the 10-year note. Well, here we are pushing toward 1% again, and we're at 1900. If we keep going past 90 basis points next week, maybe we'll get to 1880 just to keep those 80s going. But then as rates fall again, what are you going to get, another $400 rally? Maybe. That'd take us to 2200, 2300. And we conclude the week here on Friday, October 23rd, with a word of caution for next week and the days leading up to the U.S. election. I've been doing this for almost a decade now, and one of the repeating patterns that we see are efforts by the bullion banks to cap price and paint some type of chart picture, an easily recognizable formation that they can take all the way to the end and then smash to create as much downside momentum and ruin as much sentiment as possible. Heck, we saw this as recently as last month. If you recall, when price was driven lower from the highs in early August, put in a low on August the 12th, below 1900, not far from where we are right now, but then recovered. And over the course of the next, 5 weeks or so, worked sideways in a pennant formation. Looks like a triangle. Anybody could see this, even an amateur chart drawer like I am. And once we got to the very end, and notice how the last 3 or 4 candles all fit neatly into the corner, all of a sudden price was absolutely smashed on the 21st of September, and it fell over $100 over the next couple of days. As everybody saw this little pennant fail, oh boy, got to get out. We put it a triple bottom low down there near 1850, and then began the recovery that we're currently on. And now look at the current chart. Another pennant using the same downtrend line that the first one had. How about that? And all of the candles again fitting neatly into the corner, and we're already beginning to fall out. I suspect the banks will use this against us next week. Either the dollar will rally or the bond market will sell off, and we'll get smashed again. This would clear out some sentiment, clear out some spec longs, and finally set us up for the year-end rally that we've been talking about. We will not make a new lower low. We won't go down below 1850, though we may get to 1880, maybe even 1875. But from there, we'll begin our recovery. We'll get this election behind us, the next Fed Open Market Committee meeting over there on the 3rd and 4th of November, and then we'll begin to rally into the end of the year. But we'll finish this week with this word of caution. Do not be surprised by some weakness and some price smashing sometime early to the middle of next week.